Welcome to the Valuation Desk by Highland Global, where SBA business valuations speak bank. Thank you for being here today. As SBA lenders, you know that business valuations play a critical role in underwriting 7A loans, especially for business acquisitions. But here's the challenge. Many lenders, through no fault of their own, don't fully understand the underlying principles of valuation methodology. And that misunderstanding can lead to flawed underwriting, non-compliance with the SBA's SOP, or in the worst case, denial of the SBA loan guarantee. Today, we're going to walk through the top 10 most common misunderstandings SBA lenders have about business valuations, and more importantly, how to avoid them. Each point is grounded in best practices and regulatory guidance. Let's dive in. Number 1, enterprise value versus equity value. Many lenders mistakenly treat enterprise value and equity value as interchangeable. Enterprise value represents the value of the entire business operation, irrespective of its capital structure. Think of this as the asset side of the balance sheet. In contrast, equity value reflects the residual value available to shareholders after subtracting debt. In SBA transactions, confusion between these figures can lead to over or underfinancing. Clarification. SBA business valuations should clearly distinguish between the value of the operating entity, enterprise value, or the net equity value, and align this with what is being acquired based on the purchase agreement. Number 2, the role of normalization adjustments. Financial statements are not always what they seem. Lenders often take tax returns at face value, but valuation professionals don't. We apply normalization adjustments to strip out non-recurring, discretionary, or owner-specific expenses. Why? To estimate the business's true maintainable cash flow. Clarification. Normalization ensures comparability and provides a realistic view of free cash flow from a market participant perspective. Number 3, fair market value is not the asking price. We sometimes hear, but the seller wants X. Shouldn't the valuation support that? Not necessarily. Fair market value is what a willing buyer and willing seller would agree to without pressure and with full knowledge of the facts. Clarification. SBA SOP requires an independent valuation from a qualified source. That valuation must reflect fair market value, not the seller's asking price, not strategic value, and definitely not emotional value. An independent valuation doesn't just rubber stamp the purchase price. Number 4, you can't include unreported cash. This one's a biggie. Sellers often claim they have unreported cash sales, but here's the problem: you can't verify it, and it wasn't taxed. Clarification. If it's not on the tax return, it's not in the valuation. Period. Including it would not only be speculative, it could also imply acceptance of tax fraud. Number 5, projections and annualized financials are unreliable. We all want the deal to work, but leaning on projections or partial year results to justify a higher valuation is risky. Clarification. SBA requires valuations to be grounded in historical data. Projections can be considered only if they are detailed, supported, and reconciled with prior performance, which is rarely the case in small business deals. Number 6, goodwill isn't the whole business. Lenders sometimes think the business value is all goodwill. That's a misunderstanding. Goodwill is what's left over after subtracting the fair market value of tangible assets from the enterprise value. Clarification. SBA wants goodwill identified separately because it often represents the unsecured portion of the loan. Number 7, the valuation must be independent. This one's for everyone in the room, especially those involved in the transaction. There's sometimes pressure to hit the number to make a deal work. But if a valuation is influenced by the buyer, seller, or lender, it loses credibility and can put the guarantee at risk. Clarification. Independence is non-negotiable. Valuations must be unbiased and professionally prepared to meet SBA standards. Number 8, free cash flow drives value, not multiples. We hear this a lot. What's the multiple for this industry? Some lenders rely too heavily on generic multiples of sellers' discretionary earnings or earnings before interest, taxes, depreciation, and amortization, EBITDA, expecting these shortcuts to determine business value. Multiples are not the method. They're shorthand, and they're often misleading. Multiples are context-dependent, derived from underlying cash flows, and sensitive to company-specific risks, size, and industry dynamics. Treating multiples as fixed benchmarks ignores the complexity of valuation. Clarification. The true driver of business value is free cash flow, what the business can reliably generate for its owners. Multiples should only be used in context after assessing that normalized cash flow. Relying on multiples alone is like trying to price a house without looking inside. Number 9. Valuations are not appraisals of collateral. Valuations don't serve the same function as an equipment or real estate appraisal. They don't justify loan-to-value ratios. Clarification. Valuations estimate the economic value of a business based on its earning capacity, not liquidation value, and not collateral coverage. Number 10. A valuation is not the same as loan feasibility. Let's be very clear. Just because the business appraises at or above the purchase price doesn't mean the loan is safe. Valuation is only one part of underwriting. Feasibility, cash flow, and repayment capacity must also be independently assessed. Clarification. A valuation doesn't assess repayment ability, buyer readiness, or deal structure. That's the lender's job. Think of valuation as just one piece of the underwriting puzzle, not the full picture. So what's the takeaway? Misunderstanding business valuation isn't just a technical issue, it's a risk issue. It can expose lenders to compliance violations, loss of SBA guarantee, or worse. But the good news is this: by understanding these 10 key points, you're better equipped to underwrite with confidence, spot red flags early, and ensure that your deals are supported by credible, independent, SBA-compliant valuations. Thanks for joining us for this episode of the Valuation Desk. When you need clarity, confidence, and credibility, experience makes all the difference. At Highland Global, every appraisal is backed by decades of expertise and thousands of completed reports. We don't just crunch numbers, we provide insight, context, and defensible conclusions that lenders can count on. Whether it's a business acquisition or equipment appraisal, our seasoned approach helps ensure your deal moves forward with precision and trust. For more information on valuation-related topics, be sure to visit our website highlandglobal.com. Lenders know experience matters most.